We are jumping straight into a story today. It's about a monetary decision happening far away in Tokyo that is threatening to trigger a massive multi-trillion-dollar shock across the entire global financial system. And the event itself looks tiny, almost trivial.
It does. We're tracking the Bank of Japan, the BOJ, and their highly anticipated policy decision, which we're expecting on December 18th or 19th, 2025.
And the decision is this. They are widely expected to raise their policy rate from 0.50% to 0.75%. That's just a quarter of a percent, 25 basis points. But here's the monumental context you need to know. 0.75% is the highest policy rate Japan has seen since 1995. You have to go back 3 decades for a rate this high.
This is more than a technical adjustment. It is a profound psychological and structural break. For 30 years, Japan has been defined by deflation and zero or even negative interest rates. This move marks the definitive end of Japan's zero-bound era.
Okay, let's unpack this. Our mission for you today is to understand exactly how this tiny adjustment in Tokyo, this 25 basis point hike, becomes the catalyst that fixes the global financial system's, well, its infinite money glitch.
And that glitch is formerly known as the yen carry trade. For decades, it has been the hidden, silent engine of global speculative liquidity. It's fueled everything from high-flying U.S. tech stocks to the crypto boom. The scale of this trade is just staggering. Conservative estimates place the volume of leveraged capital at somewhere between $1 and $1.7 trillion.
And to put that scale into perspective for you, the learner, that's a volume of highly leveraged capital that often exceeds the entire annual GDP of a country like Spain. It's this enormous pool of money that has been operating on one assumption, that Japanese rates would stay near zero forever. So our deep dive today will analyze the surprising politics behind this, the unforgiving mechanics of the unwind, and the flashpoints where this multi-trillion-dollar shock is going to hit hardest. So let's start with the basics. How did this infinite money glitch even work, and why was it so profitable for so long?
The structure was, elegant in its simplicity. You borrowed capital in Japanese yen. Why? Because interest rates there were essentially non-existent. The yen was, by default, the world's funding currency, the cheapest debt on the planet.
The ultimate zero-interest loan.
Precisely. You took that nearly free yen, you sold it for dollars or euros, and you deployed those proceeds globally into anything that offered a higher return. That meant buying high-yield corporate debt or famously pouring it into U.S. megacap tech stocks and, of course, the crypto space.
So it was basically a leveraged financial strategy. Yeah. The cost of funding was negligible, which guaranteed a positive return as long as 2 things held true. Japanese rates stay at zero, and the yen stays weak.
Exactly. And the structural reality that sustained this, that allowed the yen to be the funding currency, was Japan battling decades of deflation. The BOJ had to keep rates low to try and spur inflation. That 3-decade equilibrium, however, is now completely shattered.
And what shattered it wasn't some, sudden blip in energy prices.
No. We're seeing structural, sticky domestic inflation. Japan's core CPI has been consistently above the BOJ's 2% target for over 3 years now. It registered 3.0% as of October 2025. This is stubborn.
And the real kicker here is the wage growth. We have to talk about Shunto.
We do. The Shunto, the annual spring wage negotiations, resulted in some of the most significant wage hikes Japan has seen in decades. And this wage growth is critical because it's a structural shift. It suggests that companies are finally raising prices to accommodate higher labor costs and consumers expect it. This wage price spiral is the signal that the deflationary mindset has finally ended. So the Bank of Japan now has an undeniable mandate to fight domestic inflation, even if it disrupts the global markets they fueled for 30 years.
Right, and here's where this stops being just about economics and becomes a really intense political struggle. This rate hike has been at the center of a massive brawl inside Japan.
You have 2 incredibly powerful forces at odds. On one side, you have the technocrat, BOJ Governor Ueda. He's focused on anchoring inflation expectations and stabilizing the currency. I mean, the yen hovering near 160 to the dollar makes imports like food and energy just prohibitively expensive.
And aggressively counteracting him is the government, led by Prime Minister Takaichi, who is championing Sanonomics, which is basically a turbocharged policy of fiscal expansion, a huge stimulus package. What was it, 21.3 trillion? Something like $135 billion.
Exactly. Takaichi's strategy was pure gas, fiscal spending to boost growth, while insisting the BOJ keep rates low. She famously called rate hikes stupid.
So you have the government flooring the gas pedal with spending and the central bank trying to slam on the brake with rate hikes, that created chaos.
It did. The market reacted instantly. The bond vigilantes investors who demand higher rates if they see reckless spending began dumping Japanese government bonds, JGBs. And this forced JGB yields to spike to 17-year highs, approaching 2%. This was a market revolt. The government couldn't borrow cheaply anymore.
So they realized they couldn't fight the bond market, the currency market, and import inflation all at the same time. The math just didn't work.
Precisely. That losing battle led directly to what's being called the December Compromise. The finance minister publicly signaled the government's acceptance of the BOJ's hike. It was a political capitulation. They essentially gave Governor Ueda the political cover he needed to raise rates because stabilizing the yen was the immediate, unavoidable priority.
Okay, that brings us to the core market risk. The political hurdle is cleared. The rate hike is happening. So what happens when that enormous pool of leveraged capital that was using the zero-interest credit card suddenly starts charging 0.75% interest, and the currency you borrowed in starts getting a lot stronger?
You get a simultaneous, synchronized margin call. The cost of servicing that enormous yen debt immediately rises. That hits your income statement. But the real explosion, the real leverage problem, happens on the balance sheet.
Tell us more about that.
The anticipation of higher rates strengthens the yen. So if you borrowed, say, 1 billion yen, and the yen appreciates by 5% against the dollar, your debt, when you convert it back to dollars, just became 5% more expensive. That immediately blows up your collateral calculations.
So it's a double whammy. Higher borrowing costs and a higher principal value on the debt itself. But wait, if these are sophisticated traders, wouldn't they have hedged this risk? Wouldn't they have bought currency swaps or options?
That's a great question, and it speaks to the hubris of the zero-rate era. Many did hedge, but the cost of fully hedging a 2-decade-long carry trade, where rates never moved, just ate into profits. Over time, the confidence in the BOJ's inertia led many to underhedge, or even drop their hedges altogether. They just accepted the currency risk for massive profits.
And now that risk is here, forcing them to close those positions.
They have no choice. To buy the newly expensive yen to pay back those loans, they have to sell their most liquid global assets. That means selling U.S. tech stocks, selling Bitcoin, selling bonds. This collective forced selling creates that synchronized structural liquidity drain across the entire system.
And this problem is likely much bigger than that official $1.7 trillion estimate because of hidden complexity.
Absolutely. The true exposure is probably closer to $2 trillion. The reason is off-balance sheet derivatives, particularly FX swaps. These swaps let institutions effectively borrow yen without the debt appearing on their traditional balance sheets. It's a way to maximize leverage.
So a massive pool of hidden leverage is waiting to be called.
Precisely. And it's not just hedge funds. We have conservative Japanese institutional money involved here too, like massive Japanese life insurers. They hold trillions in foreign assets, and they manage something called the hedge ratio.
Explain that for us.
It's the proportion of their foreign assets they protect against currency moves. Historically, they might hedge 70% or 80%, but with the yen weak for so long, the cost of hedging became punitive. So these institutions dropped their hedge ratios to historic lows, near 45%. If the yen strengthens sharply, the dollar value of their vast foreign asset holdings just shrinks, causing huge losses on their books.
And to fix those losses, what do they have to do?
They have to sell those foreign assets, U.S. treasuries, European bonds, whatever, and bring the money back home. Repatriate the capital. That adds tremendous structural selling pressure to global markets, completely separate from what the speculative traders are doing.
And the market isn't just paranoid about December 2025, it's recognizing a clear pattern. We have two solid precedents from 2024 and 2025 that show exactly how this works.
Yes. Let's look at the Black Monday dress rehearsal in August 2024. This was right after the July hike to 0.25%, the first move out of negative rates.
And what happened when that tiny hike hit the system?
That small move caused outright chaos. The S&P 500 fell 6% in 3 days. But the Japanese market, the TOPIFX index, lost a staggering 12% in a single day. This wasn't driven by bad earnings. It was a pure systemic liquidity event driven by forced selling.
And we saw this fragility amplified again in early 2025.
We did. January 2025, the BOJ hiked again to 0.50%. This perfectly coincided with news that the Chinese tech company DeepSeek had released a new, low-cost AI model. The severity of the market's reaction was the key insight here.
Explain the reaction.
The AI news was a fundamental shock, sure. But because the system's liquidity cushion was already gone, the reaction was catastrophic. NVIDIA shares collapsed 17% in a week, wiping out nearly $600 billion in value.
So the lesson there is that the rate hike had already drained the speculative capital. The yen put, that endless supply of cheap money ready to buy the dip, was gone, leaving tech stock valuations incredibly fragile.
Exactly. The market simply lacked the shock absorber. Volatility just skyrocketed because the cheap funding leverage that protected those high valuations was already being pulled.
Okay, let's get specific now. Given these precedents, where is this tightening liquidity, this strike 4 hike, going to hit hardest in December?
We have to look at crypto first. It's the canary in the coal mine for global liquidity. Bitcoin has shown a violent direct correlation with every phase of BOJ tightening. We've seen a clear three-strike pattern.
Walk us through those strikes.
Strike 1. The end of negative interest rate policy in March 2024 led to a 23% drawdown. Strike 2. The hike to 0.25% in July 2024, another 26% drawdown. And strike 3, the January 2025 hike to 0.50% led to an even deeper 31% drawdown.
So models are projecting that this December hike, strike 4, will be a potent trigger.
Yes. Based on historical deleveraging factors, models suggest the December hike could easily drop Bitcoin into the $65,000 to $70,000 support zone.
And beyond crypto, the other critical flashpoint is arguably the most systemic, the U.S. Treasury market.
Absolutely. Japan is the largest foreign creditor to the U.S. government, holding over $1.1 trillion in U.S. treasuries. For decades, this was necessary. U.S. debt was the only place conservative Japanese institutions could reliably park their savings to get any kind of return. This is the heart of the repatriation thesis.
But now, with JGB yields approaching 2% in Japan, that calculation changes completely.
Dramatically. If Japanese government bonds can offer a decent positive return without the massive currency risk, why would you keep lending to the U.S.? They don't even have to dump their existing holdings. They just have to stop buying new U.S. debt. And that creates a massive vacuum of demand.
And if Japan, the biggest foreign buyer, stops buying, U.S. Treasury yields have to rise to attract other buyers.
Precisely, which means borrowing costs, mortgages, corporate debt, everything for the entire American economy goes up. And this happens completely independently of what the Federal Reserve is doing. It's collateral damage from the end of cheap money in Japan.
And we're already seeing structural selling from Japanese banks, right? Tell us about Norinchukin Bank.
Norinchukin is a huge player, a whale in the U.S. credit market, especially in CLOs, collateralized loan obligations. They bought vast amounts of U.S. credit when yields were better.
And what are they doing now?
They're already selling. Japanese banks are actively selling around $10 trillion or $63 billion of foreign bonds to repair balance sheets that have been hit by unrealized losses from rising yields. This is structural, forced selling, and it creates consistent downward pressure on U.S. credit markets.
That's a staggering amount of selling pressure. Is there anything that can mitigate this? What about those recent U.S.-Japan trade agreements?
This is where we find a fascinating geopolitical dynamic. In July 2025, the U.S. imposed a stiff 15% flat tariff on Japanese imports. To placate the U.S. administration, Japan pledged a staggering $550 billion investment package into strategic U.S. sectors.
So we have a clear bifurcation of capital flows happening at the same time.
Exactly. The speculative capital, the hot money from the yen carry trade, is fleeing U.S. financial assets. That's the liquidity shock. But politically directed foreign direct investment, that $550 billion pledge, is flowing into specific U.S. sectors: AI infrastructure, energy grids, and defense.
The implication being that U.S. industrial stocks might find support, even as the high-flying tech sector, which depends on cheap funding, suffers.
It creates a highly selective market. Politically strategic sectors are protected, while leveraged sectors are starved of oxygen.
So what does this all mean for you, the learner? The major takeaway is that the free money window, which really defined the last 30 years of global finance, is permanently shut. The yen leverage buffer that propped up global markets is gone. It's not coming back.
We are witnessing the structural closure of an entire economic regime. The good news, if you can call it that, is the market has largely priced in the event of the December hike. But the global financial system may not have fully priced in the long term. Cascading consequences of this sustained, multi-trillion-dollar liquidity drain.
And that is the critical challenge for 2026, figuring out where the breakage will appear. The question for you to explore is this: will the synchronized deleveraging primarily just target the valuations of high-flying AI stocks that are dependent on cheap funding? Or will this stress expose something far more systemic, something concerning the solvency of major regional banks exposed to rising U.S. yields and illiquid credit assets like CLOs?
That tension between asset valuation stress and systemic credit risk is the critical uncertainty we'll all be watching next year, as Japan officially takes $1 trillion worth of global capital off the table.